Hello everyone, this video will give you a review on paying the employee. If you have Payroll Source, then this is section 5 on the Payroll Source. So let's get started. This is what we are going to cover in this section. Pay frequencies, rule for payments upon termination, different payment methods, rules governing pay statements and unclaimed paychecks, wages owed to deceased employees, and procedures for extra pay periods caused by the calendar. And also in the end of the section, there are some review questions for practice. We will do that together. The Fair Labor Standards Act does not regulate how often the employees must be paid by their employer. These matters are handled by the individual states. The common pay frequencies that are used by employers are weekly, bi-weekly, semi-monthly, and monthly. So if it's weekly, then the employee gets 52 or 53 payments every year. So if it's bi-weekly, then it means every other week, and the employee gets 26 payments in a year. Under semi-monthly pay frequency, the employee is paid twice a month, means 24 payments in a year, and monthly means 12 payments in a year. Now there may be a question on the exam where you will be given annual income and you will need to calculate the amounts for one pay period based on the pay frequency. For example, GTL tables are based on monthly costs. But if the employee is paid bi-weekly, you will have to convert the monthly cost to annual cost and then divide it by 26 to get the bi-weekly cost. If the pay frequency is semi-monthly, then you can divide the monthly GTL cost by 2 to get the semi-monthly cost. Now let's move on to the next objective, which is payment upon termination. How the employee is going to be paid when the employee gets terminated, this is not governed by FLSA. FLSA does require that the employee gets paid for all the hours worked. But how and when the employee should be paid after termination, that is governed by the individual states. Remember, on the CPP exam, you will only be tested for the federal laws. You're not going to be tested for the state laws. This next slide covers the payment methods. The employees are paid usually by cash or check, direct deposit, or pay cards. Again, this is not regulated by Fair Labor Standards Act. The individual states have laws on it. Employees must get paid as per the pay frequency, and the payment method does not matter. Direct deposit. This is the most popular payment method, and it's a type of electronic fund transfer that allows employers to deposit employees' pay directly into their designated bank accounts without having to handle a paycheck. There are many benefits of direct deposit. Some of them are no lost or stolen checks, no unclaimed or uncashed checks, saves employee time off to cash the checks, and there is no need of the storage of the cashed checks or related documents. Knowing the process of direct deposit is very important for the exam perspective. So what is the process of direct deposit? For the employees being paid through direct deposit, here is the process. First, the employer prepares an automated file of direct deposit records indicating where the employee's pay is to go. It includes the employee's bank information. The file is then sent to the financial institution, that is the employer's bank, which is also known as Originating Depository Financial Institution, and the short form is ODFI. ODFI delivers the file to the ACH operator. The ODFI makes sure the file has been prepared correctly. It checks for any exceptions and entries for employees' accounts maintained by the ODFI and processes the file through the Automated Clearing House, which is called ACH network. Now the ACH, it operates under the rules that are developed by NACHA, which is National Automated Clearing House Association. The Electronic Payment Association and processes electronic payments between ODFI and the financial institutions designated by the employees to receive their payments and coordinates with the financial settlement between participating financial institutions. The ACH operator delivers files to the employee's bank, also called the Receiving Depository Financial Institution, RDFI. RDFI is designated by the employees and accepts the electronic payments. It posts them according to the ACH rules and settles with the ACH operators for their value. Now this next slide talks about the rules of NACHA. Before the employer sets up the direct deposit for the employee actually needs to authorize the employer to deposit payments in his bank. And the employee gives following information to the employer. His name, routing number, bank account number, and the type of account in which the payment will be deposited, like the checking or the savings account. There is something called pre-notification. Pre-notification is done to ensure that the employee's bank info is correct. This involves sending $0 amounts through the ACH network as a test before the first actual direct deposit for the employee is made. Pre-notification is optional, but if used, it must be sent within 3 banking days before any actual pay is sent through the network. Under the NACHA rules, authorizations to make credit entries means deposit to employee's account, do not have to be in writing. Authorizations of debit entries, debit means removal or reversal from employee's account, that must be in writing and signed or similarly authenticated by the employee. Employers can generate a single entry reversal through the ACH network within 5 banking days from the date of the original entry. For that, they don't need the authorization from the employee. However, the rules do require that the employee may be notified of the reversal no later than the settlement date of the reversing entry. Now let's talk about the pay cards. Some employees may not have the bank account. In that case, the employer can offer prepaid electronic pay cards. They're just like the debit cards with pre-funded amounts. So the employee's earnings, they go on the pay card. Pay cards can be branded or unbranded. Some examples of branded pay cards are Visa, Master, Discover. And branded pay cards have 4-digit PIN. Examples of unbranded pay card is Star, Pulse, and the unbranded pay cards have 3-digit PIN. The benefits of using the pay card to the employees is that the employees are protected from loss because a lost or stolen card can be replaced easily with its full remaining value. All employees are eligible for the electronic funds transfer, whether or not they have a banking relationship. For employers, the benefit is reduction in the escheat issues. The next topic is unclaimed paychecks. Unclaimed checks are regulated by individual states. Most states require employers to contact employees in the attempt to keep unclaimed wages from becoming abandoned property. The state laws governing abandoned property are known as escheat laws. Under these laws, the employers are generally required to try to locate and contact the employee, File an annual report with the state where the employee resides that includes the employee's name, last name, uh, the address, amount of check, and the related payday. And then hold the check for a certain length of time before turning them over to the state as the abandoned property. And all these laws are called as cheat laws. Next, we are going to talk about the wages owed to deceased employee. They are also not governed by FLSA. Most states regulate wages owed to deceased employees in terms of who the wages may be paid, how much may be paid before administration of deceased employee's estate, and what conditions must be met before the payment can be made. There are usually three scenarios under which the employer makes payment to deceased employee. And you need to be familiar with the tax implications and reporting issues under all the three scenarios. Scenario 1 is when the final paycheck is issued right before the death but not cashed by the employees. So you will replace the check that was originally given to the employees. You will withhold all the taxes and the replaced check will be reported on the W-2. Scenario 2, when the final paycheck was issued after the death of the employee but in the same year of death. In this scenario, the wages are not subject to federal income tax, but they are taxable for Social Security, Medicare, and FUTA taxes. And they are reported on W-2 and also on 1099 miscellaneous box 3 that is issued to the beneficiary. Scenario 3. The final paycheck is issued next year. So the employee died in year 1 and the paycheck is issued in year 2. The amount is not subject to any taxes and should only be reported in box 3 of the form 1099 miscellaneous in the name of the beneficiary. Please do check my detailed video with examples on the payment made to deceased employee. I've added the link in the description box. This is the last slide before we start doing the review questions, and the topic is procedure for extra pay periods caused by the calendar. We all know that a year has 365 days and one day of the week will occur 53 times in a year. In leap years which have 366 days, 2 days will occur 53 times. If the employers pay their employees on weekly or bi-weekly basis and whose pay dates fall on the extra days of the week, an extra pay day will occur. 53 rather than 52 weekly checks and 27 rather than 26 bi-weekly checks. So the hourly employees must be paid their agreed upon hourly wage for all hours worked, regardless of the extra pay day. And the salaried employees, the employers can reduce pay for each pay period when faced with the extra pay day, so long as there is no contract guaranteeing a certain amount of pay each pay period and the employee's pay is not reduced below minimum required by state or federal law. You might see a question like, which weekday will be repeated 53 times in 2021? Do you know the answer of this? The answer is Friday. And now the fun part begins. Let's do some review questions. First one is, which participant in direct deposit process distribute EFT payments to receiving financial institution? Automated clearing house. Under EFT system, what participating institution receives the individual transactions and posts them to employee account? The answer is receiving depository financial institution. True, false. Not all states regulate wages owed to deceased employees. What do you think? Is it true or false? It's true. Only some states regulate wages owed to deceased employees. True or false? Direct deposit is one area where federal and state share regulatory responsibility. This is true.